Welcome. I'm Nils Gottfries. I'm a professor of economics at Uppsala University, and this is an introduction and overview of chapter 7 in my book Macroeconomics. And this chapter is about money and inflation in the long run. So far in chapters 2 to 6, we have been dealing with the real side of the economy, production, employment, relative prices, real wages, real interest rates. Now we're going to introduce money in the picture. And by money, we don't mean wealth in general, we mean transaction balances. We mean money that is used to make payments. And in this chapter, we discuss the functions of money in general and then specifically in our model. And we also discuss empirical counterparts to this theoretical concept of money. We discuss the concept of velocity of money and demand for money, which are two very closely related concepts. We then discuss what determines inflation in the long run and the relation to money growth. And we look at data a bit to see how money and inflation are related. We also discuss the question whether inflation is a problem, what is the desired rate of inflation? And there's also a discussion of the inflation tax and seigniorage. Seigniorage is the income that the government gets by printing money. But this last point, we will not discuss it here in this brief introduction, but you can read about it in the book. So let us start with the functions of money. So traditionally you say that money has three roles. It's a means of payment, so it's some asset that you use to pay with. And it's a unit of account. Prices and wages are expressed in terms of the money. And it's also a store of value in the sense that you can save in the form of money if you want. An example of money is coins. You can use money to make payments. Prices and wages are expressed in the same units as coins, and you can save by putting your coins in the mattress. Now, there's been a very long discussion about what money is and what is not money, and there are different views on this. Now, reality, of course, is very complicated. So we will go straight to our model and say, what is money doing in our model? So in this model, the idea is that money is used as a means of payment. And in the model, you see that because the demand for money depends on the volume of transactions. So we assume that if you have more transactions, then you need more money to carry out those transactions. Secondly, we assume that money is used as the unit of account. That means that prices and wages are expressed in terms of money. Third, we assume that money is a store of value. That is, you can save in the form of money, but it does not give any interest. So, for example, if you save in coins, you don't get any interest. And also, if you hold money for transaction purposes, you don't get any interest on that money. That means that the interest rate is the opportunity cost of holding money. If you would lend the money to someone, to the bank or someone else, you would hopefully get some interest on it. And finally, we also assume in the model, and this is quite important, that the central bank controls the money supply. So those are the four key assumptions we make about money. And when you go to the real world, it's complicated. Of course, there are many assets, and you could discuss whether they should count as money or not. Now, a kind of narrow definition of money is the monetary base, and that includes bills and coins in circulation, plus the deposits that banks have with the central bank. And the basic idea of the monetary base is that all payments that are made actually involve the monetary base. If I pay with bills or coins, then I use those to pay with. If I pay with my credit card, then money is transferred from the bank of the credit card company to the bank of the store where I bought the goods, and that transfer of money involves the accounts that the banks have in the payment system that is managed by the central bank. So in that sense, you could say that monetary base is always involved in all transactions. But if you look at it more from the consumer point of view, you could say, well, I pay either with cash or I pay with money in my account. So you could say we should include some deposits in our measure of money. And in the US, it's popular to use M1, which is bills and coins plus so-called demand deposits, which are deposits that you can use to pay for goods and services. And then there are broader definitions of money that include various kinds of other deposits. Typically, those deposits you cannot pay with them directly. You have to transfer or convert them to some other deposits in order to pay with them. So then you're talking more about broad measures of liquid assets. I argue in the book that the monetary base is closest to the concept of money in our model, because, as I said, all payments actually involve use of the monetary base. It's clearly the unit of account, and you don't get interest on the monetary base. Now, in some countries, banks get some interest on the reserves, but it's an interest which is below the market interest rate. And also, importantly, the monetary base is very well controlled by the central bank. That is discussed more in this chapter and also in chapter 10 on monetary policy. If you go to more broad definitions of money, then they will typically yield interest. You cannot directly pay with them, and the central bank does not really have that much control over those monetary aggregates. So in that sense, my view is that the monetary base is the measure that most closely corresponds to how we actually model money in this model. Of course, you may construct other models. Milton Friedman instead said that M2 was the correct or the most useful measure of money, and his model was called the black box, because actually nobody knew what was in it, but maybe someone will find out. Anyway, so a simple way of thinking about the need for transaction balances or the demand for money is to use the following equation: M times V equals P times Y. So M is the money supply, and V is the velocity of money, and P is the price level, and Y is production. So price level times production is the nominal value of GDP. And V, the velocity, is a measure of how quickly the money circulates through the economy. So imagine an economy where all the income that the firms get is paid out to the households at the end of the month as wages and dividends. And then during the month, the consumers spend the money, so the money goes back to the firms. And then at the end of the month, the firms again pay out all the money. Well, in that economy, the money would circulate through the circular flow of income 12 times per year. So the velocity of money is 12. And how much money would you need in order to make the payments? Well, 1/12 of GDP. So that's the idea of velocity. So if we think of the need for transaction balances or the demand for money, one alternative is just to say, well, we think there is some constant velocity of money. That means that the demand for money is just 1/V times nominal GDP. So in the example I just gave, if velocity is 12, you need an amount of money that is 1/12 of GDP in order to carry out the payments. You can also express this in real terms, that the real demand for money is proportional to real income. But as we said, the interest rate is the opportunity cost of holding money. So it may be plausible to assume that the velocity is an increasing function of the nominal interest rate. That is, if the interest rate is very high, people think that, well, it's costly to hold money because I lose the interest rate, so I will not have so much money in my pocket. I'd rather go more often to the bank and have a smaller amount of money in my pocket on average. And then the velocity will increase as the interest rate increases. Well, the money demand is 1 over the velocity times nominal income, and that means that if interest rate goes up, then money demand goes down. And if you express it in real terms, you could say that the real demand for money increases with the level of income and decreases with the interest rate. This will play a role, especially when we come to the short run and look at how money and interest are related in the short run and short-run monetary policy. But here we focus on the long run. So what determines inflation in the long run? Well, we have a theory here, because if we have this equation, m times v equals p times y, and we know that in the long run, production is equal to the natural level of production, which is determined by the real factors that we have analyzed in chapter 2. So we can take that natural level of production as given, and we can solve for the price level. So we get the price level is m times v divided by production. And now again we use our very convenient rule of thumb for growth rates, which we learned in chapter 1, which says that the growth rate of the price level, that is inflation, is the growth rate of the money supply plus the growth rate of velocity minus the growth rate of the natural level of production. And this is then the theory of inflation, where you have production being determined from the real side of the economy, velocity, we take it as given, say that depends on transactions, technology, and so on, and the money supply is determined by the central bank. So this is a theory of inflation in the long run. Now, if you assume that velocity is constant, then this theory gives you a very clear answer to when we have inflation. We will have inflation if and only if the money supply grows faster than the natural level of production. And this kind of reasoning led Milton Friedman to make a very famous statement that inflation is always and everywhere a monetary phenomenon. When you have inflation, it has nothing to do with anything else but the growth rate of money. So is that true? Well, this figure here shows on the horizontal axis money growth and on the vertical axis inflation. And this is a number of OECD countries from 1990 to 2010. And you see immediately that there is a clear positive correlation. Countries with high money growth, they also have very high inflation. So Friedman seems to be right. However, if we look a little bit more closely, we can look at the countries with money growth below 10%. Well, there you don't see much of a correlation. There they have money growth rates between around 3 and 9%, but they all have about the same inflation rate, around 2 or 3%. So clearly there are other things going on. So what could it be? Well, one thing is that those countries may have different real growth rates of GDP, but also that velocity is actually not constant. it actually varies quite a lot, and there are some figures in the book showing that. So to kind of take as a stylized fact that velocity is constant is not a very good idea. And especially if we look at the short run, it's a very bad idea. So the figure here on the left shows growth of money supply measured by M1 and inflation in the United States, and you see that there is very little correlation between those growth rates. So that suggests that there are other things going on, especially that velocity is actually, in practice, in the real world, it's not constant. So what can we conclude from this? Well, first of all, very high money supply growth does lead to high inflation. Second, there's a fairly weak correlation between money growth and inflation for money growth rates below 10%. That suggests that velocity is not constant, and especially not from year to year. And from that we can conclude that this equation mv times py is not very useful for predicting inflation or controlling inflation in the short run. But still, our theory says that ceteris paribus, an increase in money supply growth will lead to increased inflation. So in that sense, money supply is clearly a central determinant of inflation. And our theory says that the central bank can control the long-run average inflation if they want. But since velocity is not constant, this means that if the central bank wants to achieve some particular rate of inflation, they have to accommodate shocks to velocity. So basically, if velocity of money goes up, then the central bank has to contract the money supply so as to achieve some desired rate of inflation. Now, how central banks actually carry out monetary policy in the short run, that is discussed in chapter 10, and we won't talk more about that in this chapter. But we can conclude that money growth is one key determinant of inflation, but not the only one. Also in this chapter we discuss the question whether inflation is a problem. And basically the argument is that there can be problems with very high inflation, there can be problems with very low inflation. So if you have very high inflation, one very kind of practical cost of that high inflation is that you will have to change prices all the time, and there's costs. That will involve a lot of work to change prices. Typically we call this cost menu costs because, for example, restaurants have to print new menus. Another cost of very high inflation is that it becomes very difficult to compare prices. If all prices change all the time, it's very hard. If you stand in the store and you see the price of apples, it's very hard to say, is this a good price or a bad price, if prices change from week to week. If the price level is fairly stable, then it's much easier to keep track of the prices and compare prices. Another cost of high inflation is that there will be relative price changes depending on when the different stores change their prices. And there will also be a redistribution of money through the tax and transfer systems, because taxes and transfers are specified in monetary terms, but then if inflation goes up, then the real consequences of those systems will change. And there will also be wealth redistribution associated with wage and loan contracts if there is unexpected inflation. For example, if I make a loan thinking that inflation will be low and I make a loan and accept a low interest rate, then it turns out inflation was high. Well, then I get a very bad real return on my loan, and the borrower can be happy to make a much smaller real repayment than we had expected when we made the contract. Similar with wage contracts, if you specify the nominal wage and prices go up, then the real wage goes down. But also low inflation can be problematic. For example, there is quite a lot of evidence that people are unwilling to accept a nominal wage cut. But real wages may need to adjust both upwards and downwards. And if the inflation rate is very low, then you might actually need that some wages fall in nominal terms. But if people then don't accept that, then you don't get that wage adjustment. So you will get a form of real wage rigidity because people do not adjust their nominal wages. Another problem with low inflation is that you may end up in a situation where the central bank would like to set a negative interest rate. And traditionally, we have said that that is not possible. Now, recently, central banks have started to set negative interest rates. But the question is how far they can go. There's a limit here, because if the interest rate is set very negative, then clearly people will start to save by putting their coins in their mattresses instead of putting the money in the bank. So there's a limit to how low you can go with the interest rate. So the conclusion is that very high inflation is probably very costly. Zero inflation may also cause problems. So probably some positive inflation is optimal. Exactly what is hard to say, but many central banks today have inflation targets around 2%. These 2% is not really based on any hard scientific evidence, but rather a gut feeling of what could be an appropriate inflation rate. Okay, so in this chapter we discussed the role of money in our model. The money is the medium of exchange, the unit of account, a store of value, and the money supply is controlled by the central bank. We discussed the empirical measures. There are narrow measures of money which focus on money as transaction balances, and there are more broad measures of money that are measuring various kinds of liquid assets. We also understand that money is the main determinant of inflation in the long run, but there are other things happening, especially velocity is not really constant. We cannot count on velocity being constant. And we also learned that very high and very low inflation can be problematic. And there's also a discussion of seigniorage and inflation tax that you can read about in the book. So good luck with your studies of Chapter 7.